The broadcast is now starting. All attendees are in listen-only mode.
Good day, welcome to FXCM South Africa. Today I'll be going through a webinar called The Psychology of Trading. My name is Anu Makunike and I hope it's very informative and you do enjoy it. Please do follow us on all our different social medias. You can follow us on Facebook. The link is facebook.com/FXCM South Africa. You can follow us on Twitter, which is twitter.com/FXCM South Africa. And you can watch some of our videos on YouTube, like this one will be available on YouTube as well, and that is youtube.com/FXCMZA Forex. So before we get started, let's just go through the risk disclaimer. Past performance is not indicative of future results. Examples are displayed for illustrative purposes only and do not guarantee profits. Trading on margin can result in losses that may exceed your deposited funds. Please ensure that you fully understand the risks or seek investment advice if necessary. FXCM provides an execution-only service. Any analysis, opinion, commentary, or research-based material contained in this presentation is for information and educational purposes only, and it is not intended to be an offer, recommendation, or solicitation to buy or sell. Leverage is a double-edged sword and can dramatically amplify your profits. It can also just as dramatically amplify your losses. Trading foreign exchange with any level of leverage may not be suitable for all investors. The webinar does not have regard to specific investment objectives, financial situations, and needs of any specific person who may receive it. All videos are provided for educational purposes only, and clients should not rely on the content or policies as they may differ with regards to the entity that you're trading with. Further, any opinions, analysis, prices, or other information contained on this website is provided for educational purposes and does not constitute investment advice. FXCM will not accept liability for any loss or damage, including without limitation to any loss of profit, which may arise directly or indirectly from the use of reliance on such information. The psychology of trading. The psychological part of trading is very important, and this is because as a trader you'll always be acting under a certain level of pressure because you're required to make quick decisions and certain decisions that might determine whether you're going to make a profit or a loss. And this is just simply because you're always opening positions and closing positions on trades in short notice or even with notice, but the decision just to make that the person just to make the decision to close that position or to open that position still requires you to have a certain state of mind. So you need a lot of discipline so that you're consistent with previous trading plans, which I'll elaborate about when it comes to making trading plans. Basically it's you putting, it's knowing when to book profits and losses, and you need to ensure that emotions do not get in the way of your trading. As we go, I'll look at specific emotions, but to start off, I'd like to start by saying you need to manage our emotions because us as humans, we naturally act under the weight of our emotions. So when something good happens, we act out of joy or happiness. When something bad happens, we act out of anger or sadness. Therefore, this can affect how you trade. So the best thing to always do is avoid trading with the way you feel, because having different emotions will have a positive or negative effect on your trading choices. Just using some logic, trading on a happy day when you're having a good day could probably be the reason why you have a great day trading. So it could be positive, it could have a positive effect, but the opposite of that could also just bring a negative effect, and instead of you making profits you could make some losses. So therefore, you need to avoid trading with the way you feel completely. Your trading cannot be dependent on your moods or your emotions of that day. Irregardless of what you're going through that day or what you're thinking, you should be able to trade. If you're overwhelmed or your emotions are out of hand or out of control, you should probably just not trade at all, which is also okay. It might not be part of your trading strategy, but it's also good to just sometimes not trade at all. The two main emotions that I'll be focusing on today, there's many more than this obviously, but the two that I'd like to look into is fear and overconfidence. As we go, I'll elaborate more on fear because this is the main one that affects most traders. Overconfidence for me, how I see it, is that it's the second one that also, has a huge impact on how traders trade, but it's something that's easy to overcome and something that's easy to avoid. Whereas when it comes to fear, it's a different ball game because simply, the first time you spend money on your real account, because basically when as a trader, most traders that are actually beginners and not really necessarily experienced, open a demo account with FXCM and you do well on the demo account and you have this demo account with like 50,000 US dollars or a demo account with 2,000 US dollars, and you get on it, you jump on it, you do well, you're opening trades, you're closing trades, you're putting stop losses, take profits, you're putting your limits, you're using signals, you're using indicators, and everything is going well on your demo account. Your market analysis is great. And what happens is that you eventually put your $2,000 into your own personal account. You open a mini account with us. You have your $2,000 in a live account, and now you start trading. And for some reason, you're not as good as trading with your live account as you were with your demo. And then people say, no, the live account is different from the demo, when necessarily it's actually not. It's the same thing. But what you don't realize is the psychological aspect of it. Now that there's fear instilled in you, you're now not as as willing to make certain decisions that you were willing to make on your demo account, and that's actually where fear comes into play. So the best thing to do is to make an effort to not put yourself under unnecessary pressure and apply your strategy. Stick to the way you're trading on your demo account. Apply the same strategy that you're using that will work to your benefit, and before you know it, you'll be making some good profits and you'd be fine. I'll elaborate a bit more on fear as we go, but let me get on to overconfidence. Overconfidence is given when you're doing well as a trader. So a lot of traders start making some good funds, start making some money, they start calling themselves forex traders, which is great, and we support that 100%. But it's good for you as a trader to have a certain level of confidence, because your confidence is built on how well you're doing. So the more confidence you get, the better you do. But now what people don't understand is that also there's a level of overconfidence, which is you getting cocky and a bit arrogant because your open positions are doing so well. And what happens with that is that the more overconfident you are, the more you start thinking you know better than what you were implementing. So you don't even apply your strategy anymore, and you start, at some point everything just starts crashing down. You're not making the same amount of profits that you were. And the best thing to usually do during this point of confidence is always to maintain a certain level of composure, and always remember what your goals are and what you're trying to accomplish with your trading accounts. More about fear. So you need to understand fear. That fear, occurs in many different forms, especially when it comes to trading. For example, when your platform is beeping red because you're buying, and that's a sign that instruments are down, and negative news comes out about a certain instrument or the general market. Traders get scared. This is vice versa, whether it's on the upside or the downside of a trade. And usually what traders do is that they decide, you know what, I'm going to get myself out of this position because everything is going negatively, so I'm going to close this position. And what you have done for yourself is that you've avoided making any loss, but at the same time you do not realize that you've also missed out on some profits that you could have made. Now, this is not a complicated situation to understand, because you need to understand with trading, the movement of the market. If you have applied a certain strategy, so you've decided to put your stop loss there, and you have a limit on your profit as well, and you're doing well, and negative news comes out, the smartest decision is never just to jump out of the trade because it's going negative. Now you've avoided making those losses, but now you don't know that possibly the trade could have gone even more in your favor after just that certain dip in the market. So the trade could have gone in your favor, and you could have even made a double amount of the profits that you could have made, that as compared to the losses that you had avoided. So you as a trader, you need to understand what fear is, and that it's just simply a natural reaction to what you may see as a threat. And specifically in this case, it's your money making potential, or just simply your your profits. And the best thing to do is to quantify the fear, and it makes everything better. It'll actually make it easier for you to actually understand what you are exactly afraid of. So look at the level of loss that you're possibly going to make. And as we go on, I'm going to speak about risk management, your risk to return ratio. These things will help you overcome your fear, because you're putting certain strategies, certain things in place to avoid making the loss that you're afraid of making. Oh yeah, greed is your worst enemy, and this is a major thing. It also plays a bit into overconfidence, but mainly it looks, I'm looking at it from the point of greed. There's an old saying on Wall Street that says pigs get slaughtered. The greed and traders causes them to keep winning positions open for too long, trying to get every single profit possible to them. This action is action is bad for making profits, because the trader is always running the risk of getting whistled or blown out of position. And pretty much, as a trader, um, uh, naturally, as a human being, we always want to get more and more and more. And the point of trading is so you can make a profit. So when you are making profits, you want more and more and more. But that's one different thing as compared to greed, because wanting more is okay, but then wanting more without thinking or using any, calculated decisions, just wanting more based on you saying I want more, is not good. So you always have to look at how the market is moving, look at the position that you're in, and do not run the risk of getting whispered or blown out of position, which is bad. So you never want to stick into a trade. You want to be in a position where you're making profits with your trades, and then when you reach the amount of profits that you wanted to make, you close the position. Whereas if you keep the position open to the point that it no longer makes a profit, then that's being greedy. That's actually what I'm exactly talking about. So greed is not really an easy trait to overcome, and that's because, like I said, naturally we always want to do better and make more, and we're simply just never satisfied with what we have, and wanting more is just natural. So it's a natural thing that comes to you, but if it's now, you need the wisdom to know that this is the time to close my position, this is the time to open my position, this is the time to, receive my profits, withdraw my profits, or, spend my money. Yeah, it's like that with most things in life anyways, you know what I mean? Um, you never want to be greedy. You need to know when enough is enough and when to make a better decision or wiser decision into the profits that you're making. And a trader should be able to see if they have this characteristic, and create trade plans based upon calculated decisions, and not on a month not what's a month an emotional reaction, which is what I was saying to you, that when you're not greedy, you're no longer making calculated decisions. You're just acting out of your greed, and that's what you don't want that. So you always need to maintain your strategy, stick to your trade plans, and you should 100% be fine. Speaking of trade plans, always plan ahead as a trader. Individual investors make excuses for their losses. In anything in life, we always make excuses for things that go negatively. We usually blame it on macro uh, 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 environmental things, such as market movements, bad luck, or actions of others. Say this person made me angry, so I wasn't feeling that well to trade on that day, or someone pressed this, or someone did that. But then when you do make a profit, you always give yourself the credit and say it was your analysis and your skills, which is okay, which is also 100% true. It could be possibly true, but basically when you plan ahead, you just need to avoid when you plan ahead, you do avoid the situation of market movements or bad luck, as said, from what's going on. And basically to do this is that you need to calculate your potential earnings before your losses, and use your money as your work tool, and you must preserve it. And this is what I was talking about when I said, the risk to return ratio. And basically the risk to return ratio, for example, requires a trader to consider the target price, and the ratio is usually expressed in pips. So if the stop is at 30 pips and the limit is at 90 pips, you have a ratio of 1:3. And basically this will allow a trader to catch up to 3 losing trades by winning 1 trade. Okay, this is a big deal that everybody needs to understand, and this will help you as a trader to always maximize your opportunity to make profits. Risk management is a big deal, and a lot of people don't understand it and don't realize that this is very important, because usually when you're just as a trader, you're trading and you're not taking into account the losses that you're making, and next thing you know, boom, all your money is gone. If you have a ratio of 1:3, what it means is that each time you make, okay, for every 3 losses you make, you need 1 profit to cover those 3 losses. That means technically speaking, essentially your losses are always covered, so they never actually do touch your equity because your profits cover up for your losses. So now think about it like this. If you make three losses and you make one profit, right, your losses are cancelled. So if you make three losses and make two profits, your losses are cancelled. You're now back at a profitable position, and then you make another profit with your second profit. If you make three losses and three profits, you're now just moving at a profit. So if you make three profits and nine losses, you haven't lost anything. You're still in the same position that you could have been. So this risk to return ratio is very, very important. It's something that needs to be maintained, and it goes into your strategy. So as in your strategy, I'll talk about it a bit more as well towards the end about your stops and your limits, that you need to know where to put your stops and your limits. But usually, if you have it at a ratio of 1:3, so your stop is at 30 pips and your limit is at 90 pips, then you're perfectly fine, and you'll be able to absorb losses easily. And that's what you want to do. Think of it as a boxing match. For each punch you give, and you receive three punches, your one punch should be stronger than the three punches you receive, and that's basically what it is. Um, you know, Nevertheless, a too large ratio will diminish your opportunities, which is why 1:3 is perfect, perfect, perfect. 1:2 is also not too bad, but 1:3 is where we consider it, pretty good and pretty decent. Okay, a lot of traders have lacks of knowledge, and like they don't know what is going on, and that's the reason why they actually make some losses as well. This is a big thing, and what a lot of clients that are successful traders with FXCM, what they really like about FXCM is the way they provide knowledge to their clients. And basically what I'm talking about is you want to avoid learning at your expense. So there's certain um, commodities and certain contracts that have trading hours and expiration dates, and there's economic announcements or point values and margin required. um, and a lot of retail traders lose money in the financial markets because they don't know anything about um, all these positions. So what you want to do, I'm sorry, not positions, but all this information. So actually, let me just show you on our website where it's accessible for you, and just so you can better understand what I'm talking about. So I go there. Okay, so if you go on to fxcm.za.com, this is the website that we have if you haven't been on it, but I'm sure most of you have seen it. But this is our website, and basically we offer, trading services, um, and a whole lot of research and education. Under research, you have what we have, the economic calendar. Economic calendar is very, very important. It's just loading right now. Okay, so it tells you when there's certain events that are going to affect the forex market or the contracts market, or any the financial markets actually in a whole. Whether you're trading forex or stocks or anything, this shows you the upcoming events, everything that's about to happen, independence days, unemployment changes, the market services, the NZ commodity price, you know, majority of your events are all here. And the nice thing that we've now added to it is that instead of just telling you about the news, we show you the volatility of the market at that time during the announcement, and put in percentage form the consensus and the previous, the difference in the previous percentage that there was when this happened. It's available in days, the following day, this week, next week, and then you can search for certain, events according to the currency pair that you're trading. The volatility will be shown, and the category that you're looking like in terms of the specific information. So if you're looking at what the central banks are doing in terms of the USD, you'll look at that, the government of the USD, the holidays and everything else. Following to that, we have our market news, which is, great because you always want to know what's going on in the markets. Um, it's just also loading a bit slow. There we go. So the global market news is all available for you. As you can see, it changes. So Canadian dollar, then next thing you know, Euro USD, USD, CAD, anything New Zealand, everything's available to you. The currency pairs are here, the categories are here, the popular searches, because there's a lot of movement in DAX and gold. So it's all available for you there. Then obviously we have the charts that are available. This is all knowledge and information that's easily available to you. If you don't know how to look at it, or you don't understand it, or you don't know how to read it, feel free to call in or pop in an email to one of the your account executive or anybody in FXCM South Africa, and with we'll be ready to always assist you. What I want to show you is that we have a product guide available. So I'm just going to search here for time. Instead of just there we go. We have a product guide available. So if you're into commodities, I mean CFDs, the indices and commodities in your treasury, under your product guide, there's a lot of information that's always available for you. So if you click here for the DAX, the German 30, it shows you the trading hours. You just simply click here, so you always know the hours that they trade at for the different instruments, XPS 500, the NAS 100. That's all here. So you don't want to open a trade when it's not trading hours. Next thing you know, you just lose your money, or you want to open a trade during the expiration date or anything like that. If you open a trade today and the next thing you see tomorrow you've made a loss, and you're thinking, you know what, you're going to open a long-term trade and in 3 months you're going to make this amount of profits, but now you've made a loss. Actually, not in 3 months, a month, because they have expiration dates. It's probably because you just didn't know that it was going to expire. So the target spread is there available, as well the max contract size and the pip cost and value and other information. It's all available for you on our website and easily accessible to you as well. So feel free just to go on fxcmza.com and you can find it there. Alternatively, you can feel free just to contact me or any of my colleagues, and we'll be able to assist you simply. Traders should try to learn about their area of interest as much as possible. So with all the information that I've shown you, it's simple as well. What I like to do is, because I like trading Forex a lot, so my Euro USD is one of my favorite currency pairs. So the GBP USD and the Euro USD is what I always trade mostly. What I do is that I'm always on, I always have Bloomberg available to me on Twitter, just in case there's some interesting news, and also have Financial 24 just for some local South African news, just in case there's changes in the exchange rate, some hectic movements. So it's always great to just have those things available to you easily. It's everywhere. The internet is something that you can use. TV, Bloomberg, it's all available to you. Some evening news will also assist you pretty well, just to see where the markets closed at, and just so you can also know where the markets have opened at. If it's very possible, please also just start to make a habit of attending trading seminars. This is not just for your learning purposes, but it's also good to be amongst other people that trade and have the same interests as you. You guys could share ideas. You could help each other in terms of the knowledge. You could actually learn some good strategies from other people that are in these seminars as well. And that's pretty much what you need to do, and also spend some time on your demo account so you can plan and you can plan out and devote as much time as possible to the research process and practicing on your demo account. So that's actually something that's very, very important. Um, and create some trading rules. So this is part of your trading plan, ahead of time. Make some trading rules. Basically decide. Remember, I told you, for example, the risk management, you want to have stops at 30, limits at 90, for example. So you need to know where to put your stops and your limits. Lay out guidelines based on the risk-reward relationship for when you exit a trade, regardless of your emotions. So, for example, deciding when to make, how much profits you want to make in this trade, or according to the trade size that you're trading. It's good to know when to exit a trade. A lot of people don't know when to exit a trade. They're always thinking, oh, a profit, a profit, a profit, a profit. And then boom, next thing you know, the market volatility has changed, how the market is moving, and now you're at a loss. So you also have to know when to exit a trade, regardless of how you're feeling, whether it's excitement or anger. It's good to know. Establish price targets, like I said. Decide when you want to make that profit, and where you can nicely pack up and say, I've made my profits for today, and you know you know I'm happy. So it's not a big issue. Or if there's certain news that comes out, such as positive and negative earnings, or macroeconomic news comes out, you need to know if you're going to buy or sell. And usually what happens that when a large buyer or seller enters the market, the trader might want to get out. So if this is not part of your trading plan, You need to know how a way to counter it to work in your favor. And this is all simple stuff that it's just a matter of you just taking some time, just to implement these few steps. So basically, I've also told you about this. When you win or lose in a day, deciding that you know what, this is enough for me. Let me fold out my tent and go home. It's a very important trading rule, and it'll help you in maintaining your profits. So in conclusion, these are basically the 4 points that I want you to, take home with you. Besides, just the trading with your out of emotions, I think take time to develop a trading plan and apply a positive risk to return ratio. Specialize in 2 to 3 assets to get a good timing. So like I said, for example, with me, Euro USD, GBP USD, and now I'm starting to get the hang of the DAX a bit. So the German 30, I'm starting to understand it a bit better, and I'm starting to enjoy trading it as well. So those are my top 3 that I trade. So do that as well. They're part of my trading plan. I have a positive risk to return ratio on them. And investors are psychologically influenced in their market decision. They rely on their own knowledge and information they have to make decisions that are wrong. So like I said, Twitter, get on Twitter, check out Bloomberg. If you like Facebook more, go on Facebook. Just have Bloomberg as one of your accounts that you follow or like, just so that when that information does come out, it's there, it pops out. Or Financial 24, the information pops out. Check the news out, so for the information. Or give us a call and just be like, hey, what's the word on the Euro USD today, and we'll be ready to assist you and to give you that knowledge, as it is easily accessible to us as your account executives as well. The real trader cannot gain on the foreign exchange market, or more generally on the markets, without having knowledge and awareness of the biases that affect them, which goes back to my point of being aware of what's going on around you. Much of the profitability of this type of investor therefore lies in the psychological management, which represents 50 to 70% of the trade. Like I said, the fear and the overconfidence and everything else that I spoke about plays 50 to 70% of your decision when you trade. So if you master your feelings and maintain your trading plan, you'll minimize the psychological part of the trading in order to optimize your success. I think this is pretty much logic. So if you master that 50 or 70%, that has an effect on how you trade. The other 30% will pretty much be your knowledge. So 70% is basically going to you psychologically, and then 30% is knowledge and trade plans. Next thing you know, you'll be doing pretty well because you understand 100% of how to trade and how you can make some good profits. Other than that, that is it from me. If you have any questions, feel free to email me at amakunike@fxcm.za.com. My name is Ano Makunike, and I will attend to your questions as soon as possible. Thank you very much for listening.